Money Roots is made possible by the support of our sponsor, Rooted Planning Group. Are you ready to take control of your financial future? Look no further than Rooted Planning Group, your trusted partner in financial well-being. At www.rootedpg.com, you'll discover a wealth of resources and expertise to help you thrive financially. Rooted Planning Group specializes in personalized financial planning, investment management, and retirement strategies. They understand that every financial journey is unique, and they're here to guide you every step of the way. With a team of experienced advisors, Rooted Planning Group is committed to helping you cultivate a secure and prosperous future. Visit www.rootedpg.com today to learn more about how Rooted Planning Group can help you grow your money roots. Welcome to Money Roots, the podcast where personal finance gets personal. Each week, Amy and her guests dig deep into the world of finance, making it more approachable and understandable for everyone, no matter where you are on your financial journey. From savings and investments to budgeting and planning, we'll bring you practical advice, inspiring stories, and expert insights. We believe that everyone has the potential to grow a healthy financial future, and we're here to help you nurture it. So whether you're a financial guru or just starting to plant the seeds of your financial knowledge, this is the place for you. Get ready to uncover the tools and strategies that can help you thrive financially. So without further ado, let's dive into today's episode of Money Roots.
Hello, podcast listeners. Thank you for tuning in once again. This is Amy Irvine, CEO and founder of Rooted Planning Group. I'm here to say all you need is love and a good financial planner. I can't take credit for that. That was something that I actually saw on the back of a t-shirt at a conference that I attended several years ago. So I just thought it was a perfect opportunity to share that, starting in the month of love in February. And I truly do believe that life is so much better when we can just find time to be around the ones that we love and to share time with them. But today's topic is a little more serious than that. It's about, I guess, year to date, what's been going on. Certainly, there's been a lot of information in the news and a lot of scramble to try to figure out exactly what's been going on. We'll put a link to a video that we put out earlier this month around tariffs in the show notes if you want to learn a little bit about that. But today, certainly I wanted to talk about what happened in the month of January. It marked a positive but very volatile start to the year for investors amid market shifts and policy concerns. President Trump returned to the White House and signed dozens of executive orders that Chinese artificial intelligence company DeepSeek shook the tech industry, and the Fed hit pause on rate cuts. So those three things were pretty impactful in the month of January. Looking forward, investors are focused, I believe, more on the latest rounds of tariffs and impacts on the global economy, and certainly inflation continues to be a concern. Some key market and economic drivers: the S&P 500 gained about 2.7% in January, the NASDAQ 1.6%, and the Dow Jones Industrial Average was up about 4.7%. The 10-year Treasury yield ended the month at 4.5%, but reached a high of 4.8% in mid-month. And remember, yield means that the price went down. When we see a higher yield, that means that the price went down. When we see a lower yield, that usually means that the price went up. The Federal Reserve held its key policy rate at 4.25 to 4.5 following three consecutive rate cuts. But they did express, that they wanted to pause and kind of take a look around and see what was going on, which I think is why we saw that short-term price decline in the higher yield during the month of January. U.S. GDP grew about 2.3% in Q4, 2.8% across all of 2024. So inflation remains stubborn with the consumer price index rising at 2.9% year over year, and personal consumption expenditure index climbing to 2.6%. Some of the big key topics in January: AI, tariffs, and the Fed pause. I mentioned those earlier. In January, financial markets were driven by technical disruption and policy transitions. A reported AI breakthrough by the Chinese company DeepSeek led to declines in some technology stocks, certainly notably NVIDIA. DeepSeek has purportedly built cutting-edge models that require 95 to 97% fewer resources to train than those created by OpenAI and other leading companies. While this is still being validated, OpenAI alleges that DeepSeek utilized its model, the possibility that the industry requires far fewer computing resources and energy has rippled through the financial markets. So information technology stocks were impacted across the board by AI. We saw positive growth in all of the sectors year to date except technology. So technological developments matter for all investors, not just those who are focused on tech stocks, because these sectors have grown in importance in the past several years. Technology and artificial intelligence now represent a significant portion of the major indexes like the S&P 500 and the NASDAQ, and are increasingly used by every sector of the economy. So another important development is in Washington, where the Trump administration implemented new tariffs, including the 10% tariff on China and potentially the 25% tariff on Canada. A 25% tariff on goods from Mexico has been paused, and from Canada has been paused for a month after reaching a deal with the two, or I guess they're still in negotiation as of this recording. That may change by the time it's released. Seems to be changing on a daily basis at this time. Tariffs have created uncertainty around the global trade relationships, inflation, and even economic growth. Canada has already responded with their own tariffs on U.S. goods as of yesterday. And I'm recording on the 4th of February. So that gives you some idea when you're listening what may have happened between the recording and when this is actually being released. But the exact economic impacts are not yet clear and will take some time to unfold. While tariffs imposed during President Trump's first administration were primarily focused on specific industries in China, the new measures cast a much wider net. And the new tariffs impact our closest trading partners. So that stated purpose of these tariffs is to generate additional government revenue, to negotiate on border security, and to protect domestic industries. It's important to keep in mind that markets also feared escalating trade wars in 2017 to 2019. And despite many uncertainties, markets generally performed well over that period of time, and businesses adapted by diversifying their supply chain. Ultimately, tariffs were a means of negotiating new trade deals, such as the United States-Mexico-Canada Agreement, what's called USMCA, and the Phase 1 trade deal with China. Economists and market analysts project these measures could have economic implications for consumers and for businesses, including the possibility of higher inflation. And various sectors face distinct challenges. The automotive industry must navigate complex cross-border supply chains. Agricultural importers are, they're kind of struggling and trying to grasp what potential price increases on fresh fruit and produce could be. And energy markets need to adjust to new costs on Canada oil imports. Even though it could be at a lower 10% rate, it's still an increase. Despite the market's immediate reaction, it's certainly going to take time to play out. So I think it's one of those things that we need to be calm during the negotiations. The answer is usually somewhere in the middle. Finally, the Federal Reserve decided to keep rates at 4.25 to 4.5% at its January meeting. This represents a pause in rate cuts after lowered rates at the previous 3 months meetings. Currently market-based measures suggest that the Fed may cut rates only twice in 2025, although these expectations can change quickly. The Fed made this decision because the economy is growing steadily. The job market is strong and inflation remains stubborn. Recent data shows that inflation accelerated slightly over year-over-year basis due to factors such as energy costs. Long-term interest rates have remained elevated as well, which suggests that investors also believe the monetary policy will need to remain restrictive for an extended period of time to ensure price stability. All I can say is staying disciplined will only grow in importance with investor attention focused on implications and implementation of the new administration policies. Certainly also the Fed Reserve decisions and ongoing technology developments. Those are all going to require some, hold and steady kind of behaviors. Just keep doing what you're doing, I guess is the best way to saying it, because over time, we know that typically these shocks to the system flush out. With these factors continuing to influence markets, those who can maintain a broader perspective will probably be better positioned to achieve the overall financial goals. So hopefully this was helpful. We understand that these times can be stressful, and we certainly want to make sure that we provide enough information so that you feel like you can hang tight and continue to save. And if there's a need for cash soon, then we may want to talk about shifting some of the assets as a whole, or you may want to think about shifting some of your assets as a whole, because it's never a great idea to keep short-term needs and long-term investments, in our opinion. Thanks everyone for listening. We hope you enjoyed this podcast. If there's more information that we can share with you that helps educate you in any given way, we would love to do that. Please drop us a note and share this with anybody that you find might get some use out of this information or find it helpful. Thank you so much, and we hope that you have a lovely February.
You've been listening to Money Roots, your go-to podcast for making personal finance accessible and approachable. Thanks for joining us today. Amy and her guests have enjoyed guiding you through the roots of your financial journey. Remember, whether you're planting new seeds of financial knowledge or nurturing the growth of your existing financial plans, Money Roots is here to support you every step of the way. Be sure to follow them on Facebook, X, LinkedIn, and Instagram for more resources. And, of course, subscribe to Money Roots wherever you get your podcasts so you never miss an episode. A big thank you to the sponsor, Rooted Planning Group, for making this show possible. At Rooted Planning Group, they're committed to helping you cultivate a thriving financial future. Until next time, keep growing your money roots.